Anytime you hear a lender talking about making loan decisions, you're going to hear about the 5 C's of credit. And the 5 C's are character, conditions, collateral, capacity, and capital. As we're considering your loan application, we're going to pull a credit bureau report. And we're going to look at the credit score. The credit score, it's known as a FICO score. It goes anywhere from 300 to 850. Most people in the United States have a credit score of 720 to 850, somewhere in that range. A few major things that go into that credit report and in that credit score. Number one is your payment history. So about 30% of your credit score is just your credit history. Do you pay your bills on time? When they're due, do you pay them? And if you don't, it's going to show up on the credit report. It'll show if you've been 10 days late, 30 days late, the number of times that you've been late, and that really hits your credit score if you're not making your payments on time. The next most important piece is your credit utilization rate. So if you've got a credit card and it's got a $10,000 limit on it, you never want to use more than $3,000 of it. You want to max it out at about 30% of your available credit limit. Even if you pay it off religiously every month, you don't want to go over $3,000 because that's increasing your credit utilization rate above 30%. That's going to hit your credit score. If you find yourself constantly running $4,000 on your credit card that has a $10,000 limit, increase the limit to $15,000 so you're below that 30%. Number 3 is your credit history, or your length of credit history, I should say. So how long have you had that particular credit card in place? I occasionally will talk to somebody and they say, well, I've got a 0% credit card. In 6 months from now, that rate is going to be up, but then I can find another credit card that offers a 0% and I'll just roll the balance from one to the other. That's going to really hit your credit score. The one thing that doesn't hit your credit score very much, and a lot of people think it does, is if your credit is being checked. So if you come in, you write a loan application with us, and then maybe 3 months from now you take another loan or you apply for another loan with us, and you think, oh my gosh, I'm going to get my credit hit twice. That doesn't really have much of an impact on your credit score at all. It's really your credit history, your history of paying bills on time, and then your credit utilization rate. Those two are by far the biggest factors that go into that FICO score. So sometimes that credit report is going to turn up things that you might not know about that's really important in the lending process. So we're also going to use that credit report to verify the debts that you reported on your balance sheet. The next thing that we look at in the lending process is capital. That's where we're looking at that balance sheet and we're figuring out how much equity you have. The next piece of that is cash flow and the capacity to cover loan payments that you have. And that's why we ask for that month-by-month cash flow projection. The next part of that is collateral. So how much collateral do you have? If it's only the collateral and whatever you're purchasing, then the loan amount's probably going to be 70% of that collateral value. But you may have other collateral that doesn't have a loan against it, that we can use that collateral to maybe increase the loan amount. I just went through 4 of those 5 C's. The 5th one is conditions. So we've looked at the other 4 C's. We looked at your character, we've looked at your capacity, your capital, and your collateral, and then we've gotten to the end and we're saying, okay, if we make this loan, we're going to ask you to update your balance sheet once a year, or we're going to ask you to provide us with your tax returns every year, or you have to hold insurance on whatever it is that we've financed. So those are the conditions that might be put on a loan approval. So that's basically the lending process.